For as long as most of us can remember, we've had a pretty clear idea of how the housing market works, right? It's about families saving up, getting a mortgage, and buying a place to call home. But a fascinating new working paper from the European Central Bank suggests that whole picture is changing, and may be changing for good. So today, we're going to dig into this research and explore how a powerful new force is rewriting the rules of the game.
And it all really boils down to this one central question. Who is actually buying our homes these days? Because the answer, as you're about to see, is probably not who you think, and it has massive implications for every single one of us.
You see, we usually think about the market in terms of regular households and the banks that give them loans. But the reality is, over the last decade or so, a whole new kind of buyer has been making some seriously big moves, operating on a scale that can literally reshape an entire market.
Okay, so first things first, let's pull back the curtain and find out who exactly these new players are.
We're talking about institutional investors. Now, these aren't individuals or families. These are huge organizations. Think giant investment funds, insurance companies, even pension funds that have so much capital, they can buy up residential real estate, not just one house at a time, but by the entire portfolio.
Now, just take a look at the sheer scale of this shift. This chart from the ECB paper is incredible. Starting around 2013, you see this dramatic, steady climb in purchases. And see that big yellow chunk of each bar? That's investment funds. I mean, they are, by a long shot, the biggest force driving this whole surge.
But here's the thing, this isn't happening everywhere. This map does a great job of showing the hotspots. All this investor money is heavily concentrated in certain countries, like Germany and the Netherlands, and in major cities like Paris, Dublin, and Madrid. The darker the blue, the more intense the investment. So what you get are these pockets where the housing market has become, well, financialized, where homes start acting more like stocks to be traded than places for people to live.
So what happens when literally billions of euros from these massive funds flood into just a few specific areas? Well, the research shows it kicks off a huge chain reaction.
The research lays out a pretty clear cause and effect chain. First up, these institutional investors jump into a market, which skyrockets the overall demand for housing. All that new competition naturally leads to step two. House prices don't just go up a little bit, they rise persistently, month after month. But here's the real twist. The research finds this is also tied to an increase in mortgage lending to regular households. Why? Because as prices climb, families are forced to take on bigger and bigger loans just to have a chance.
And hey, this isn't just some theory. The paper puts it in black and white. This quote right here confirms that the link between big investor demand and rising prices is one of the core findings of their whole analysis. The main takeaway here? This is a real, documented force that's actively changing the market.
But it's not just about prices going up. This goes way deeper. The very logic, the very DNA of how local housing markets work starts to change. It's like the entire rulebook is being rewritten.
Okay, this slide right here is absolutely key to understanding the whole issue. In a traditional market, house prices are, at their core, tied to what local people can actually afford to pay, their incomes. But in these new investor-influenced markets, that connection just breaks. Prices get detached. And at the same time, these markets become way more sensitive to things like central bank interest rates, and they're suddenly exposed to all the ups and downs of global financial markets, almost like they're stocks or bonds. So let's just break that down for a second. First, when prices get disconnected from local wages, you get huge affordability problems and a much higher risk of a housing bubble. Second, that heightened sensitivity to monetary policy means that when interest rates go up or down, these investor-heavy areas feel the impact on prices way more strongly, creating all these unequal effects across the country. And finally, linking local housing to global finance means a stock market crash on the other side of the planet could suddenly ripple right into your neighborhood's housing market.
So look, this isn't just some abstract economic debate for experts to worry about. The research makes it crystal clear that these shifts have huge, system-wide implications that really do affect everyone.
And this, right here, is the big headline. The paper concludes that these institutional investors have become systemically relevant. Now, that's a pretty heavy term from economists. What it means is that their actions are now so big, they can affect the stability of the entire financial system, not just one or two local markets.
So what are the risks that come with this? Well, they're pretty serious. You've got a much greater risk of housing bubbles. It can amplify the boom and bust cycle, making the good times better, but the bad times way, way worse. And this is the really critical part. It builds a direct bridge between a crisis in the financial sector
and the housing that people rely on every day.
After all this data, all this analysis, it really brings us back to a very simple but really profound question. As our homes are increasingly treated just like any other financial asset, to be bought and sold by global firms looking for the best return, it really forces us to ask, who are they for?